Good morning, everyone. Just taking a walk around the city this morning, trying out a new pair of sunglasses on this bright sunny morning. So there are three considerations that every property investor should really think about, and I'm going to share these with you now because as a property investor, there's a certain mindset that you've got to have. And I don't mean mindset as in, motivation and all this. I mean your mindset and your paradigm about what you're investing in, how to invest, and how to get the maximum return. And I'm going to unpack these three things for you just while we walk around here and enjoy the beautiful Sydney Harbour foreshore. So the first thing is you've got to remember that when you become a property investor, when you first start out, typically you're renting and then you're going to make your first investment, or you own a home, you're paying off a mortgage there, and you're getting your very first investment. That's how everyone starts. Consider this for a moment. When you invest into the share market, for example, typically you're not buying shares in one company. Typically what happens is you're investing into a group of companies, a fund of companies, into an index. Now what that basically means is, for example, in America, you've got the S&P 500, which are the top 500 companies of one particular industry, right? And when you buy into that index or buy into that fund, or there are funds that invest into that index, essentially what you're doing is you're buying a part share of over 500 companies. Now, this diversifies your risk because at one time, all 500 companies are not booming. At one time, all 500 companies are not crashing. So you mitigate risks because at any one point in time, some of those companies are going up, some of those companies are going down. Overall return is what we're looking at there. So many people can say, hey, well, that limits your upside, because many people say, hey, don't diversify. But ultimately, you've got to have some type of diversification to limit that downside risk. Now, with property, it's very different, because what you're hearing in the media is you're hearing about cities that are booming, flattening, busting. You're hearing about locations and regions that are going up and going down. But that's actually quite detached from an individual property in an individual suburb on an individual street within that city. So you can have, for example, a market which is falling behind, like you can have, for example, Sydney. Now, at times from 2020 to 2023, Sydney was booming. At other times it was busting, and at other times it was booming again. Now, when it was falling, not so long ago, there was areas, locations, which were actually booming as overall Sydney was falling. And so this is what you're going to be very careful of. You see the guys here fishing. They're enjoying it. They're loving it. So you've got to be careful as a property investor, because remember, you're picking one city, one region, one suburb, one street, one property. So the first thing to remember as a property investor is you're getting that one location. You're not diversified. And so you've got to get that location correct. All right. And you've got to be thinking about two things. You've got to be thinking about short-term growth. Okay, what growth can you get in the short term, the next 1 to 2 years? Because you might be relying on that growth to create the deposit on property 2, property 3. You've also got to think about long-term growth, because ultimately, if you go into a location which was just booming for that 1 or 2 years and they won't grow again for 15 years, and that does happen, it happens more often than you think, then that will wind up being a very bad investment. I do see way too many potential would-be investors thinking like that, thinking incorrectly. Hey, what location is going to get me that 50 to 100 grand growth in the next 3 to 6 months? And not thinking about the long-term sustainability of that asset, of that particular property, to double in value in the next 10, 11, 12 years, which is ultimately what you want to achieve. Okay, so that's the first key important point, is remember that you're picking a location, you're picking a suburb and a street, one location, you're investing into that one area. You've got to get it right, and you've got to consider short term but more importantly, long-term growth potential of that property, because most of the gains are made over holding the property for at least 10 years. You've got a lot of entry costs on the property, stamp duties, etc., and you have a lot of exit costs from the property as well. So trying to make your profits in 1 to 2 years simply doesn't work, and that's why you're really seeing the death of buy, renovate, flip. You've seen the death of, you know, people buying a property, even trying to like split a block or do like a mini development. By the time you work in all the entry costs, the interest costs, the council costs, the costs of going through the mini development, then on top of that you add all the taxes you pay on the way out and the fees you pay on the way out, and weigh that up against all the risks. It just doesn't make sense. And so I'm a huge advocate of low deposit leverage in a safe way. Leverage as much as you can, buy and hold properties with the right cash flow and tax deductions, and over time you're going to make that money. Unfortunately, there are no shortcuts in property, believe you me. Okay, so let's quickly discuss the main points of choosing that right location. Ultimately, you want an area with high demand and very low supply. Where do you get the supply from? Well, you can pull future supply out of the council website. You'll see all the approvals, what's under construction, what's being completed. So you'll know, and also zoning of the different areas, what can be built, what development applications are in, and then you can see, hey, what's likely to be built here over the next 3, 4, 5 years. That can be determined. If you get the time and the tenacity to go through and work all that out. Not easy thing to do, but it can be done. The next thing is you got to look at the demand. So how desirable is this location? Now, what leads into desirability is affordability, a feeling of safety, accessibility, amenities, health, education, employment. And if you can get all those things right, then you're going to be in the right area. But you must balance the demand versus the supply. That's key. And when you do that and get that right, it's proven time and time again, you'll be in a long-term sustainable growth location. Just remember, there are over 15,000 suburbs all across Australia. So just be very careful about that. You know, you might only be considering 3 or 4 locations. You really want to be running the numbers on all 15,000. Now, that's your location. Now, point number 2, you've got your individual property. Now, okay, so you've got a lot of demand for this location. People are pouring in. You've got renters, home buyers, people that want to buy a home, people that want to rent, and they're looking for an ideal property. So you've got to make sure that for this location, and it's going to be different for every location, that you've got the right property type. This is key. So you might have the question right now, should I invest or avoid an apartment? Should I invest or avoid townhouses? Should I invest or avoid in a house with land? Should I be buying brand new? Should I be buying existing? They're all generalizations. All of those properties work in the right location, in the right market, where there's a limit on supply of that type of property and there's huge demand for that type of property. I'll throw up one example. This is an example of a client of mine that I worked with. Now, they had a very limited budget and they had about $450,000 to work with, which really isn't a lot. And what I sort of said was, well, we're going to go for a 1-bedroom unit. Now, they first responded by saying, well, I've read this, heard this, podcast this, watched this TikToker, heard from this property guru, blah, blah, blah. And, you know, apartments are always a bad investment. Anyhow, I'll get to the end of the story, and pretty much we got her in on a 1-bedroom apartment for $450,000. Now, the property actually had a $15,000 rebate on it. It was brand new off the plan. So you're able to negotiate a pretty good price when you're buying off the plan, especially if you're buying multiple properties in a buying group like I do. And pretty much she got that property for $450,000. 2 years later, at completion of the property was valued at over $700,000. So what I'll do is I'll just throw up what this property does look like. Here's also a graph showing what she purchased it for, and also the bank valuation on this property as well. I'll throw that up as well. And so why did this work? Well, it worked because in this particular location, there were a lot of young single people that wanted access to all the amenities in this area. Amenities such as cafes, restaurants, bars, public transport to be able to get to and from work, close to employment situations. And also they're looking for something affordable, okay? Affordable, something affordable. And you're finding that a lot of people don't want to do the share accommodation. You know, they don't want to share a kitchen or anything with anyone. They want their own place. And so there was actually a lack of supply of one-bedroom accommodation in this particular area. Even in the new building that was going in, very few of the apartments being built were one bedroom. Now, because there was big demand in this particular area for that type and a very low supply of that type, we can see those booming prices. So you've got to be very careful, because if you generalize about property type, for example, if you go into an area where there's a bunch of houses, thousands and thousands, tens of thousands of houses, but you've only got demand from 1 or 2,000 and the supply is 10,000, then those houses will not grow in value. Okay, not always is it just like the land, the value is in the land. So I hope that's a lesson, because once you choose your location, you then got to get the right property type. Now, whether or not that property type is a one-bedroom unit, a 4-bedroom townhouse, a 5-bedroom home, a double-story home, a single-story home, whatever it might be, we've got to determine that and figure out, well, in that suburb, what's on offer in that suburb? Where is the niche market in that suburb, which potentially is being underserved in terms of location, housing type, parking, number of rooms, okay, space, yards or no yards. Some people want the no yards. So you've got to look at all of that and analyze all of that. That can take some time. Now, once you actually do go in and secure that property, you've got to make sure that property is well built. It has the right appliances. It has the right layout. It has the right features. Okay, so if you can get all of those things right, what's going to happen is that particular property will be more attractive than the other properties. So say, for example, this one-bedroom example that I did bring up. So pretty much there would have been some other one-bedroom apartments in that building that didn't grow as much. So you've got to choose the best, again, out of what's available in that niche market. And that's when you're going to over-index, you're going to beat averages. Okay, so you've done your analysis, you've got your suburb right, you've got your property type right. Okay, now the last part is to ensure that you're gonna mitigate the risk on this property. Now, there are a few main risks. I'll cover a couple of them. So the first one is you don't want to overpay for that property. You don't want to get ripped off on this property. Now, you can get ripped off by our mum and dad that simply will not sell the property unless it's going to be at a huge amount. The problem that we're seeing now is because listings are so low on existing property with mum and dads inside the property, what's actually happening is they don't want to move out of that property unless they get their ideal price. And there's so many buyers right now that when you get an existing property, it can be really, really tough to get the value. Potentially what people are doing, if there's development potential on the property or there's growth potential in that area, what they're doing is they're trying to price in that growth potential. They're trying to price in that development profit that potentially could be there. It's always potential. You know, people say, it can be developed. Well, when you really run the costs and go to the council, it can be a very different story. So be very careful there. So they try and price that in. So what actually ends up happening is you pay for that property a price which literally soaks up the next 3, 4, maybe 5, maybe even more years of the growth on that property. So you've got to be very, very careful. If you're buying brand new, you've got to be very careful that there are not extortionate amount of fees and charges on it, that the materials being used are going to be great. It's a good, reliable builder that you can trust. So you've got to be extremely careful, whatever avenue it is that you're going down, because you never want to overpay for the property, okay? If possible, you want to try to get a discount. I mean, I've become very expert at putting groups together to go in and negotiate on prices, specifically on brand new. That's where I do concentrate, because I understand the risks there and I can mitigate them. And I think any strategy does work, as long as you understand the risks with your particular chosen strategy and you've got risk mitigation strategies in place. All right, that's what's really key there. Okay, we're just here at the Harbour Bridge, the Opera House. No wonder property is so expensive in Sydney. It's so beautiful. Okay, so now let's move on. Okay, so risk mitigation. Never overpay for your property. Don't overpay for your property. Don't pay for the seller's profits over the next 3 to 5 years. I see that happening time and time and time again because you get FOMO, fear of missing out. You go to an auction, or you've got a buyer's agent that's nagging you, hey, everyone's after it. It's true, everyone is after it. But remember, you pay another 20, 30, 40 grand, 100 grand, whatever it might be. And then you've got your buyer's agent fee on top of that. So it's really soaking up a lot of cash that really should be going towards holding more property. Now, of course, if you can find a property where there's less immediate demand, it's unknown demand, the property is unknown, or it's not being listed out there in the retail market, then potentially you can do a lot better. Okay, cash flow. So cash flow is 3 things. What rent do you expect to get every single week? How many weeks per year do you expect for the property to be vacant? And what is the annual rate of rent increase? You've got to look at that, because if you get the right area, over 2-3 years, you could experience 20 to 30% rent increases. This substantially improves your cash flow, which means you can borrow more money and you can own more property, which is always a good thing if you're in the right properties and got the right structure behind you. So you've got to look at, okay, what is the predicted rent? One way to do this is talk to 3-4 rental agents in the area that you're thinking about buying. Work very closely with them. Not only are they going to instruct you on what rent, but they're going to instruct you what a renter is prepared to pay a premium for. All right, Scott, in this particular area, people that can get an alfresco area this size with these features will pay more. People in this area that can get a study, right, will pay more. People in this area that have 2 areas for living, there's a lot of families in this area, 2 living areas, will pay more. So you got to understand that. The next thing is obviously vacancy. Now, typically, the way I work with it is I always work with getting a rental agent to guarantee my rent. I do that for myself and my clients, but I've got the volume there of leases to be able to do that. So the average investor can't really do that. So I like to have my rent guaranteed. But if you don't have that rent guaranteed there, well, how many weeks per year do you expect that particular property to be vacant? You've got to factor that into your cash flow projections. You've then also got the rent increases, okay? So you want to factor that in. That's going to come down to supply demand of rental accommodation, the right rental accommodation in that area, as we discussed in point 1. Now, the last point that I'll add to that is depreciation, because depreciation will give you massive tax refunds, but you only get the maximum depreciation on brand new property. It's one reason why I focus in on that strategy as well. Okay, guys, so I'll leave you with that. Those are the key areas that you need to be thinking about in terms of your mindset and the framework that you've got as a property investor. Take care, guys.
For more videos like this, please click like and subscribe for more information around the property market. Thank you.